In this video, we want to take our final look at the capital structure decision, assuming a perfect capital market. So the effect of leverage on the risk of securities certainly can be expressed in terms of beta. We've talked about this in previous videos. So the beta sub u, right, unlevered, you take the, if there is a debt structure, right, times the beta of equity. This is the proportion of equity, proportion of debt times the beta of debt. So a measure of the risk of a firm as if it didn't have leverage. That's what unlevered beta is. It's the equivalent to the beta of the firm's assets. So if you're trying to estimate the unlevered beta of a project, what would this beta be like if there was no debt? Or what would the beta be if there was no debt? You need to look at some comparable kinds of investments. So leverage amplifies the market risk of the firm's assets. See here, here's debt, right? So beta sub u is the unlevered beta. So the actual equity beta, right, is leveraged up, right? There's a market premium now for the company dependent on what proportion of debt they have. So here's a company. We're going to generate some EBIT of 10 million. We have 10 million shares. Stock price is trading at 750. And we're trying to decide whether to change its capital structure by borrowing 15 million at 8% and using the proceeds to repurchase 2 million shares at $7.50 a share. So how's that going to work? What's the earnings per share? Currently, it's $1 per share. And again, there's no interest, there's no taxes, so it's $1 per share for this company, again, that has no leverage. If they recapitalize the new debt, right? So they're going to have to make interest payments each year. 15 million is what they're borrowing at 18%. That's 1.2 million a year. So they're going to have expected earnings now are going to change to 8.8 million rather than the 10 million. So their new EBIT or earnings is $8.8 million. So how many shares do they have? Well, they bought back 2 million shares. So the earnings per share actually rises to $1.10. So this company's expected earnings per share is going to increase with this leverage. Does this mean that shareholders are better off? And the actual answer is no. The expected earnings per share rises, but also the risk rises. So while earnings per share increases, on average, it's usually there to compensate for the riskiness of being a shareholder. So LVI's share price does not necessarily increase as a result of this transaction. And this is, again, in a world of a perfect capital market. What about dilution, right? Essentially, we're saying here, an increase in total shares divides the fixed amount of earnings. So sometimes, as they mentioned here, it's incorrectly argued that issuing equity dilutes existing shareholders' ownership. So again, here we have a company. They have no debt, 500 million shares outstanding at $60. They're going to expand. They're going to buy $1 billion worth of asset that they're going to finance with new equity. So prior to the purchase, the company had a market value of $8 billion. Again, they're going to sell 62.5 million new shares at $16 a share to raise the additional $1 billion, right? 1 billion divided by 16 is 62.5 million shares. So what we see here is And we have $8,000 in assets, total value $8,000. The shares 500 divided, that's $16. Here's the $1 billion in cash that's added. Existing assets were $8 million. Total value is $9,000. So now we have 562.5 million shares. Divide that into the 9 million. Again, that is $16 per share. So the market value of the asset grows, but we also divide that by a greater number of shares. So the actual value per share of stock has not changed. As long as the firm sells the new shares at a fair price, there's no gain or loss to shareholders associated with the equity issue itself. So any gain or loss associated with the transaction comes from the net present value of the assets. Again, it's the assets that drive value, not the way we pay for those assets. With perfect capital markets, financial transactions neither add nor destroy value, but represent a repackaging of risk and therefore returns. It implies, obviously, that any financial transaction that appears to be a good deal may be exploiting some type of market imperfection. Again, this whole series of videos has all been about this perfect capital market. In that perfect capital market, again, the value of a levered company is exactly equal to the value of unlevered, for numerous reasons why that seems to be true. But this is all under this context of something called Modigliani and Miller without taxes. The value of the company doesn't change when you change the financing. Look forward to seeing you in the next video.